Choosing the right S&P 500 EFT is crucial for long-term investing. Today, we're comparing three of the most popular EFTs tracking the S&P 500: VOO, SPY, and IVV. We'll break down performance, fees, dividends, liquidity, and which EFT might be right for your portfolio. An overview. VOO, Vanguard S&P 500 EFT, is a broad market exposure with low cost and ideal for long-term investors. SPY, short for SPDR S&P 500 EFT Trust, one of the oldest and most liquid EFTs popular among traders. IVV, iShares Core S&P 500 EFT, very similar to VOO, is low cost and widely used in brokerage accounts. All three EFTs track the same index, but differences in structure, fee, and liquidity can impact investors differently. Starting off with VOO. VOO is a broad market EFT tracking the S&P 500, with top sectors being technology, healthcare, financials, and consumer discretionary. Its top holdings are Apple, Microsoft, Amazon, Tesla, and Alphabet. Its performance over 1 year is moderate growth and tracks the index closely. Over the 5 year is strong long-term growth and ideal for buy and hold investors. Fees and dividends. The expense ratio is around 0.03, which is very low, and the dividend yield is around 1.3% and is paid quarterly. Best for long-term investors seeking low-cost, broad market exposure. We have next SPY. It is a unit investment trust, a UIT, tracks the S&P 500. Top sectors, similar to VOO, is tech-heavy. The top holdings are Apple, Microsoft, Amazon, Tesla, and Alphabet. Performance is almost identical to VOO, but can experience slight crash due to the UIT structure. Fees and dividends. Expense ratios of around 0.09% and higher than VOO and IVV. The dividend yields are of around 1.3% and is paid quarterly. Liquidity and trading. Extremely high liquidity, tight bid-ask spreads, excellent for frequent traders and option strategies. Best for active traders and institutions valuing liquidity and tight spreads. IVV. It is a broad market EFT from iShares. Top sectors and holdings is nearly identical to VOO, and the performance matches VOO very closely, almost indistinguishable in returns. Fees and dividends. The expense ratio is around 0.03%, same as VOO, and the dividend yield is around 1.3%, and it is paid quarterly. It is best known for long-term investors who prefer iShares platform, low fees, and consistent performance. Historical performance and market context. Over the past 5 years, all three EFTs, VOO, SPY, and IVV, have closely tracked the S&P 500 index, delivering similar annualized return. Bull market. Growth surges often slightly favor SPY and IVV due to liquidity and trading advantages. Bear market. VOO and IVV's low expense ratio allow long-term investors to retain slightly more capital over time. Major events impact. COVID-19's crash in 2020. All three EFTs dropped similarly, but rapid recovery highlighted the resilience of US large-cap companies. Tech rallies, 2020 and 2021. EFTs with heavier tech exposure like SPY briefly outperformed slightly due to the trading volume advantage. Key takeaways. Over long periods, performance differences are minimal, and choice mainly comes down to fees, liquidity, and personal trading style. Final verdict. VOO has best for low-cost, long-term investors wanting simple S&P 500 exposure, while SPY best for traders needing high liquidity and tight spreads. And IVV, very similar to VOO, is ideal if you prefer the iShares EFTs or certain brokerage integrations. So a summary, all three EFTs deliver almost identical returns. Your choice depends on fees, structure, and trading style. Thank you for watching. If this video helped you, hit the like, subscribe, and save it for your investing decisions. See you in the next one.